Thanks for tuning into the Conversations podcast, powered by Avenel Financial Group and the Co-Investor Club. I'm Sam DiFiore, your Conversations host. From time to time, Mike Pruitt and other team members will be your hosts depending on our guests. We are endlessly curious about the world of business and the journey to success. Inspiration and motivation shape people into the best versions of themselves. Success doesn't come alone. It comes with the support from others. In Conversations, we dive into life stories that contribute to successful careers.
This podcast is for informational purposes only and not a solicitation of an offer to buy or sell securities. We may buy any company mentioned and make a profit if those securities rise in value. We recommend you consult with a licensed financial professional before purchasing or selling any securities referenced in this podcast.
We are excited to host Artem Fokin, founder and portfolio manager at Khan Capital, LLC. Artem is a Russian native who spent his childhood in Siberia. Artem now lives in the beautiful Marin County. His path to professional investing is an interesting one. He earned several law degrees, a Juris Doctorate equivalent from the Higher School of Economics in Moscow, a Master in Law in International Taxation from New York University School of Law, and even wrote and defended a PhD thesis at Moscow State Institute of International Relations while working full-time in New York at a major U.S. law firm. The PhD dissertation was converted into a book and published in Russia in 2009. That book was recognized to be the best book published in Russia that year in its category, Financial and Tax Law. At the age of 22, he started his professional career in New York as an international tax attorney. But after practicing for a few years, he left NYC and started his MBA studies at Stanford Graduate School of Business. After graduating from Stanford Graduate School of Business as an R.J. Miller distinction given to the top 10% of the graduating class, Artem entered the investment profession in 2011 and launched Khan Capital, LLC in 2015. Artem's analytical work and research have received public accolades. His work was featured in Barron's, and he was the winner of SumZero's Top Stocks of the Year for 3 years in a row, 2017, 2018, and 2019. We are excited to welcome Artem Fokin. So, Artem, why did you name your firm after a famous chess opening?
Well, so most people ask me first what's the name is about, and then they try to figure out whether I'm Karo or whether I'm Khan. And since my name is nothing like those two names of two wonderful gentlemen, then many people are actually confused, and then they find out that it's chess opening. Okay, so first of all, when I was growing up in Russia, I used to play chess when I was 10, 11, 12, and I really liked it. That's number one. Number two, and by the way, chess, Karo-Kan was specific chess opening that I used to play at the time. And when I was thinking about the fund name, I wanted to pick up something that is personal to me on the one hand, and on the other hand, has conceptual parallels with the investment style that I'm pursuing. And the way I draw the analogy between my style and this chess opening that I used to play is focus on not just on the upside, but also thinking about your downside protection. And this is what I mean. There are some chess openings that are a lot more aggressive and gun blazing than Karo-Kan. While Karo-Kan is the opening for the, not for the whites, but for the blacks. And if you're and in that case, you can either, and remember, the whites always have an edge in chess because they have the first move. Some people say that's about half a pawn edge. And if you're not playing white, you need to think whether you want to go very aggressive and guns blazing, which is more risky, or you say, you know what, first I'm gonna build a good, solid defense base here. And then I will think about attacking and trying to win later. So that's the conceptual parallel that I saw between Karo-Kan as chess opening and margin of safety concept pioneered by Ben Graham. So that was the second reason, and that's how the name was born.
That's super interesting. And also, I always like to talk to people who are really into chess because they seem to think analytically almost about every aspect in their life. It seems that chess had a great inspiration early on if they started to play.
Does chess as a game have a lot of implications for life and investing? Definitely. However, I do believe that games where there is a randomness element, where there is an element of chance, whether it's poker or whether it's backgammon or whether it's something else, I think it's actually a better approximation of life and investing than chess. Because in chess, think about it this way, objectively, if you play, if you or I play a great chess grandmaster, we have zero chance of winning, like zero. In any single game, he or she will beat us, hands down. However, if you play a game of chance against an equal caliber grandmaster in that particular game, whether it will be a poker and you play with some famous poker player, on any single hand, you can win. Same with backgammons. Why? Because there is an element of good luck, there is an element of bad luck. You may be playing a particular game where a superior player had bad luck, you got good luck, and maybe you did something well based on that good luck and you win. Investing is a little bit similar. Sometimes I would get lucky, and in investments where I should have lost a little bit of money, I would come ahead and make some money. And it's very important to realize that that was not because I did something superb in terms of my analysis, but it was randomness. Similarly, sometimes I would have a wonderful thesis, but a bad luck will, destroy it and lead it to an unfavorable outcome. Like, think about many people who had beautiful thesis on, I don't know, a restaurant company that growing its unit base at a rapid speed and has attractive unit economics, and they invested on January 2nd, 2021. Their thesis probably was very robust, but guess what? It went out of the window in February and March and April. So that's kind of bad luck. And that was, not foreseeable and not analyzable really on January 2nd or January 3rd of last year. But let me pause here.
No, absolutely. So how would you describe your investing style?
Okay. So this is the probably most concise summary that I can come up with. I want to be looking for a multi-bagger investments, meaning investment opportunities that can go up in price 3x, 4x, 5x. And I've been running Caracan Capital LLC for about 6 years, slightly more by now, almost six and a half actually. And I think one of the biggest changes that happened with me as an investor was that I became a lot more demanding on the upside. And this is what I mean. When I started, if I find an investment idea where I can make 50%, 50 in the next, year or 2 years, I would be excited and working super hard and diligently and applying all my intellectual energy and research efforts into figuring out this opportunity. Now, if I find an idea with a 50% upside, I probably would not get out of bed in the morning. I mean, I'm kidding. I still will get out of bed, but not for that opportunity. And now I want to find something where I see a very, very plausible path to 100, 200, 300, 400% returns. To be clear, not all of them will play out that way, but I want to see that path, and it must be plausible. It cannot be just in my imagination. It cannot be a hallucination. And the reason why I evolved that way is this. If I look at something that can go up 50%, in my opinion, if my analysis is right and the company does the right things on the execution, guess what? My analysis will be a little bit off, and management execution can be a little bit off. And it's going to take longer for the market to realize that the stock is mispriced. And eventually I will end up making 20 or 30% 2 years later. And that's not a very attractive return that will justify a lot of analytical work and a lot of analytical efforts. However, if I think that the stock, the company's intrinsic value can go up 4 or 5 times in the next 3 years, even if I am wrong on the edges in my analysis, even if a little bit of bad luck happens, and even if it takes a little bit longer, the stock will still be a double or triple in the next couple of years. So, and by the way, and So that's really, in my opinion, justifies the new approach. Because one key metric that, in my opinion, every portfolio manager has is maximizing return for the portfolio on the unit of time spent. In other words, if you have 1 day of work or a week of work, or pick any unit, and you can spend it, you want to generate the highest return for the entire portfolio. So that's the metric that I'm trying to optimize. And very often I hear this pushback when I talk to my friends like, Artem, isn't it more risky? So you found some idea at 4x or 5x potential, some plausible path. And doesn't it mean that also has a crazy inherent risks? And my response is generally twofold. Number one, that's exactly my job, to analyze those risks. And if it's a very binary, then I will pass. And second, that's number one. And second, what I've come to realize is this. Generally, if I see an opportunity where I believe there is a legitimate path to 5x return, for example, it probably means that the company is doing something pretty incredible on the product or service front and keeps customers incredibly happy and enthusiastic and happy to make referrals and do all those things. And that quality of the service or product offering and the quality of the compelling customer value proposition, in my opinion, de-risk that investment substantially. And that's what I focus a lot on.
So building off of that, when you find a stock that might go up 100, 200% in your view, how do you walk me through your allocation process if you decide to put 20% on it, 40% on it? I know it's a broad question, but how do you go about that?
Do you mean the percent of the portfolio, Alec, or do you mean how quickly I build it up?
Well, I mean the percent of the portfolio, but that was actually a question for later, like how you decide if you're going to average into a position or not.
Okay. So remember, everybody does it in a very individual and specific way. And I think this is less about the intellectual approach and more about matching your psychological profile with the type of investments you do, with the type of specific investments you're picking. So you're matching your personality, your overall style, and then company idiosyncratic factors. I normally have a limit, and this is more of my own guidelines, where I don't like making positions bigger than 7 or 8% at cost. And the reason why I don't like making them bigger is because I want to reduce the impact of, number one, me being wrong, number two, any bad luck or randomness that can happen in the world. Imagine that hypothetical example that I mentioned about a restaurant company with wonderful unit economics and strong growth investing in January 2020. Like if you put 7% position, for example, and it's down 70% during COVID, your portfolio will survive and your portfolio will be able to weather through that period of time. But if you put like 20% return or 20% position or 30% position, that's pretty difficult to come back. And any of those terminal mistakes, meaning when you really got the investment thesis wrong, they can really ruin your portfolio. And I never want to be in that position. So that's why I prefer limiting at 7 or 8. But even 7 or 8, this is a pretty high hurdle to get. Like very few positions, the way I run the portfolio, will get to that level. It must be an incredibly high conviction with very strong downside protection and very, very, very big upside. Because when I think about sizing the positions, that exercise, like if you think about it, what I talked about idea generation and what gets into the pipeline research, that's a lot more about upside, right? I want to have very high upside there. But when it comes to sizing, this is where downside is a lot more important. If I believe there is a legitimate chance of company losing 50% or more of intrinsic value, it can never be a big position. Can it be a 1% position or 2% position? Sure, it can be. Because in that case, if I'm wrong on the 2% position, I lose 1% of the portfolio. But if I'm right and it goes up 5 times or 7 times, that's a very sizable impact on the portfolio. And then obviously it's about me judging probabilities, whether it will be a favorable outcome or unfavorable outcome. So, but that's how I think about position sizing. And it's not that uncommon for me to have, 3% position in the portfolio. That's fine. And I can always adjust it later to the higher size if I see that appropriate.
Okay. So when you create, like, say, an 8% position, do you have like a specific entry strategy where maybe you invest in blocks as the stock falls, and say like you invest half of it at once, the stock pops up, and you're like, okay, you know what, I don't want to invest anymore? Or do you invest in large chunks and try to do it all at once, sort of lump sum style?
It's incredibly rare for me to have a 7 or 8% position on day one.
Okay.
It's incredibly rare. And the reason why it's super rare is this. If you found an investment idea a month ago and you spent an entire month researching the stock, you never lived through earnings releases with this company. You never lived through successful or unsuccessful product launches. You never lived through board members changing or CFO changing. You don't really know this company as a living organism, as a living body. You studied the history of that company through filings, through earnings calls, through Google searches, through research publications, whatever you use. You spoke with management, trying to understand what they did a year ago, 2 years ago, 3 years ago, and how it impacted the company's direction. You talk to customers and learn about how they like the product, but you never lived with this company through real life, in real time. However, when you own the position and the company goes through earnings releases, you learn so much more about the business than you did through that historical study. And normally, in order for the position to get to 7 or 8%, again, normally there are exceptions, I would need to live with that company as a living position through a few earnings releases and through a number of developments. And only then I will say, okay, now I can invest. And now I can size it up to 7 or 8% or 7 or 8% position. But again, that's rare. And normally for me to have a 7, for example, when I look at the portfolio today, most of the positions that got to a bigger size, they got there through appreciation. And it's pretty rare for me to get a very big position, 7 or 8% at the beginning. It's just rare.
Yeah, that's understandable, definitely. I think Sam has the next question.
Yeah. Who inspired you to become an analyst or a portfolio manager?
That's a good question. I'm not sure I will be able to point out any particular inspirational figure. So because I came to investing late in life, I was trained as a lawyer in Russia. And when I was 21, I came to the US and I did 1 year Master of Laws program. And then I practiced international tax law at a big law firm in New York. And only after that, I went to Stanford Business School. And after finishing that, I got into the hedge fund world. So it's hard for me to point out any specific figure. I think it was more through, I developed interest in investing. And at that time, I didn't know which specific asset class, Sam and Alec, through my work as a lawyer, because I saw what clients were doing. I thought, like, that's pretty cool analytical exercises. I really like that. I didn't know whether it will be private equity or public equities, whether it will be more with investing approach or more with trading. I didn't know those things. That's what I was figuring out while I was at Stanford doing my MBA. So it will be difficult to pinpoint any specific individual who inspired me to become an investor.
I appreciate that, the honesty too behind that. So what's your favorite part about this job?
So in my opinion, this is an area of human activity where eventually meritocracy prevails. Because think about it. If you pick investments well, and if you do good analytical work, you will be proven right. Sometimes it takes a little bit of time. Sometimes it may take 2, 3, 4 years to be proven right. But eventually you will be proven either right or wrong. And by the way, many things that play a role in other human activities, how well you like, how well you network, how well you do this or that, it plays a very de minimis role, right? Like think about private equity. You can be doing I have a lot of friends in private equity. I never worked myself in private equity, so my view may be a little bit incorrect, but I think as a big picture, it's fairly representative of the reality. So think about this way. You're working as a partner in private equity firm, and you found a great company that very few people know about. It's somewhere in Midwest. You flew there, you spent time with management, you did the diligence, you really want to invest. And guess what? Maybe there are a few other firms that are competing with you for the same deal. This is not public markets where I can go buy shares, you can go buy shares, Ali can go buy shares, right? So it's very different. It's now obviously there are syndicates and sometimes they partner up, but think about simplistically only one firm going to buy 80% stake and management will keep 20% stake for themselves. So the management will be choosing eventually based on who offers more money, and second, whom they like more and want to partner more. That's a very different game from any three of us going to the public market and buying shares of XYZ today because we think it's going to go up 3 times in value in the next 2 years. XYZ management doesn't need to like us. XYZ management doesn't even know maybe that we exist. If it's a big company, a small company, we may get in touch and talk to them and everything. But I like that. I like that element that it's a little bit like chess, right? If you're a good player, you will win the game, right? You might not win all the games, but you eventually, your winning percentage will be higher than your losing percentage. So in investments, it's a little bit the same. If you do your work well, that's the only thing that matters for the outcome of your investment decisions.
So you mentioned management teams a few times. Although both are optimal, what do you weigh more on, the horse or the jockey?
The bigger the business, it's more about the horse, even though management is very, very important, obviously, as you said. The smaller the business, it will be a lot more about the jockey. In other words, the high quality of the business, in my opinion, can offset many poor or suboptimal decisions by management team when it's a big established business. However, when it's a small business, even if it has high quality characteristics, poor decisions by management may be brutal, sometimes even fatal, who knows, for that specific company. Like, think about it this way. If a giant company makes a wrong acquisition, a poor acquisition, they can probably survive that if they mishandle integration or if they overpay. If it's a small company making a sizable acquisition relative to their size, and if they cannot digest that acquisition and integrate well, and manage the 2 cultures merging into 1 culture well, and keep the clients happy during the transition, that can be a fatal mistake for the business.
Yeah, I like that answer a lot.
You are listening to the Conversations podcast, a production of Co-Investor Club and Avenel Financial Group. Making your own investment decisions and interested in the best microcap managers? Go to www.coinvestorclub.com and sign up to receive weekly investing insights.
This next question probably goes pretty well, actually, with the question I asked earlier about entering positions. But how do you manage excess cash in your portfolio? So, like, I know some people or some managers tend to hold less cash than others because they want to think more about opportunity costs and force themselves to think that way and maybe sell their worst holding in order to create a full size new position. And I was curious how you try to minimize the drag on performance from cash and whatnot.
Okay, Alec, that's a terrific question that will have that's very difficult to answer. So I will share with what I do. And remember, this is always work in process and there is a normal evolution element there. But this is what I do today. Remember, the portfolio, the cash position in the portfolio is not an input. It's more of an output for how many ideas that I find appealing and truly attractive I can find. If I can find a lot of ideas, then my cash in the portfolio would be very, very small or even zero. However, if I am not finding a lot of good ideas, then cash will have certain level, then portfolio will have a certain level of cash, whether it's 5%, 10%, 15%, who knows? Again, that's the product of the environment, and that's the product of how well I am finding attractive ideas. Generally, what I found is that since I tend to fish mostly in smaller names, whether it's micro caps or small caps, with there are exceptions, but this is generally where I spend most of my time. I generally tend to find enough ideas to have a very little cash position, generally. But if I cannot find, yes, I will have more cash in the portfolio.
Okay, awesome.
Because think about it this way, you're trying to balance two costs. Cost number one, market goes down at some point 20% or whatever, and you're close to fully invested, and you do not have cash in order to take advantage of some bargains in the market. That's one cost of not having free capital when asset prices are cheap. Another cost is the opportunity cost of you not being fully or close to fully invested in normal times. And if you believe that you can pick investments that can compound the intrinsic value and their prices will reflect that at very high rates, that can be a very high cost of you not investing enough and having too much cash on the balance. So that's the balancing exercise, and everybody makes very individual choices, and I don't think there is the right one.
Yeah, I actually think the answer varies depending on the portfolio size and whether you have a closed fund or an open fund too. Just because, like, take me for example, if I'm managing my own portfolio, I'm 22 years old, so my portfolio is relatively small. If I go invest my check, all of a sudden I have I increase the size of my portfolio by like 10%. So I'm leaning towards betting bigger when I do, because I constantly have this cash coming in. But if I have this large portfolio and every time I add cash to the fund, I'm only adding like 0.5%, I'm more inclined to keep a larger cash balance on hand for, any opportunities that come my way. So I think it kind of, I don't expect there to be a set answer. I think it's kind of, you evolve depending on, the fund, the size of the fund, everything. So
remember, I think there is a big difference also between someone like you managing their own portfolio versus someone who manages an outside pool of capital. I think it's a different.
Definitely.
It's a very different profile, right? So whatever I say, that should not be. I don't believe it's always appropriate or contextually right for an individual investor, right? So I can see how someone who manages their own capital will be doing it differently than someone who manages a fund. So I can see that there will be differences, unavoidably.
Yeah, definitely. Appreciate the color though.
Speaking of evolving as an investor, did you learn from your successes or your failures more?
Look, you learn from both, right? The important thing is that probably when you learn from your successful investments, the impact is bigger. Like, think about it. What's the most horrible investment you can make, right? You invest in something that something goes to zero, right? That's the most horrible investment. Think about most successful investment. You invest in something that goes up more than 10x. So just mathematically, your impact on the portfolio will be a lot bigger from your successful investment. And if you can take those learnings and internalize it and apply it to the next investment and find another one with a similar potential upside that plays out, that's a lot more impactful. But I learn from both. I learned both from my mistakes. I learned both from my very successful outcomes.
And is there one or a set of metrics that you place greater emphasis on when making investment decisions?
Customer satisfaction, customer value proposition, quality of the product or service as perceived by the customer. Think about it this way, Sam, it's ultimately the customer who will define the destiny and fate of the business. It's not even the management team, right? Even though, yes, sure, management team impacts the product and product impacts the customer satisfaction and happiness and everything. But the highest level of abstraction, it's the customer who drives the business outcomes. If the customers love the product, the business almost destined to do well as long as they don't mess things up. And if everybody does not like the product and happy to switch to a competing product or service when it comes out at 10% cheaper price, guess what? That business not gonna succeed long term. Can they have a good year? Yes. Can they have 2 years which are good? Sure. But long term, very unlikely. So I place the most emphasis on the customer and customer happiness.
Yeah, that really stuck with me the first time we chatted too. when we were going through the top 50 list, and you said, does it solve a problem? And now anything that I look at, I immediately think of you, where I say, what is the problem that this company is solving? And is it going to survive? Is their problem solving skill going to survive? And I think it's just so important when looking at certain investments.
Yeah, I agree, 100%.
Do you have a favorite book currently, or a favorite podcast?
Okay, favorite book. Look, I will just, how about this? I will answer the questions about my favorite investment books in general. It doesn't have to be like today. So my favorite investment.
Investing be anything you'd like to.
So my favorite investment book has been since the time I've read the book, that has been my favorite investment book. It's Joel Greenblatt's You Can Be Stock Market Genius. So I think it's a terrific book. I recommend it to everybody. I've always recommended it to my friends, to people. Exactly. So Alec, just for those of you who are not on video, Alec just went out and pulled from his bookshelf within like probably 2.5 seconds, if not less. He pulled out the book by Joel Greenblatt. I think it's a terrific book, right? So, and when you ask me which investor I admire the most, I probably would say Joel Greenblatt. So I think, again, his track record is impeccable as an investor. He is a terrific thinker, a terrific writer. The only problem is that now, with that book being out for the last few decades, I feel like there are too many people who've read that book and trying to emulate that style. So it has become a lot more difficult to make strong returns by just deploying that style. So you need to evolve and change and look for those things. But it's my favorite investment book. So, or like of all times. And in terms of what I've read recently, the most recent book that I finished is Richer, Wiser, Happier. It's a profile of 7 or 8 investors. I think it's a great book, and it shows that there are very different styles how you can be successful, but you need to match that investment style to your own personality. And that's what you and I talked earlier on the podcast, guys, when we talked about sizing and idea duration and this and that. So I like that book among the most recent ones I've read.
Going back to the topic of poker versus chess, do you think that we could make the judgment or the assumption that these grandmasters of chess could be the institutions in the finance world today? And that's why you think that poker has a larger effect on individuals who want to create a great amount of wealth?
That's an interesting question. I've never thought about it that way. Okay, so the analogy which you're drawing is this. If we analogize investing to chess, and there are grandmasters, and those grandmasters think about as multi-billion-dollar investment entities, whether mutual funds or hedge funds or whatever. And then there are individual investors, or there are small investment firms that they also need somehow to figure out how to make returns. And if you analogizing the investing to chess, then these guys have zero chance. So that's the question. While we analogize it to poker, there is some randomness element. I don't think I would like that analogy. I don't think I subscribe to that analogy, even though it's a very interesting thought experiment. And here's why. Because if we go with that analogy, then it means that whether it's you're an individual investor, like you, Sam, and like you, Alec, or whether you are managing a relatively small investment firm, then it means that you're saying like, listen, whenever I make successful investments, I'm just relying on randomness that played out in my favor. So I don't think so. So I think what I would probably, and remember one thing which is funny, obviously, I used to play chess, so I understand the game. I actually do not play poker. So whatever analogies I make, I'm always running the risk that it will be a poor analogy. So I think I would probably say this. As an individual investor or small fund, one of your edges is that you don't need to try to compete with Magnus, the current chess champion who will be facing his opponent, Yanni Ponce, in literally a few months from now. You don't need to try to play the game and win against him. Or even we bring poker, you don't need to try to go to Las Vegas and play at some huge national competition that is held once a year. World Series, right?
I think so.
World Series of poker, right?
World Series of poker.
Yeah, I think so. So you don't need to go there, right? You can, the way I would analogize that is that you can go to a local chess club in your small town where you live, right? Or if you live in a big town, you can go to a still local chess club, or you can go to a place where it's legal to play poker and play at a small table where your level of skill will be higher than the level of skill of the opponents. So I think the biggest and the edge that that someone like you may have is go to invest in smaller companies where big institutions definitionally cannot deploy their capital.
Yeah. I'm glad chess came back up because I've been sitting here this entire time waiting for another opportunity to say this. But
Okay.
I got this one move in chess. I don't usually play, but it's in 4 moves you win the game, where I move a pawn up, and I think there's like a knight involved, and I move my bishop and my queen out, and I try to attack the pawn that's diagonal to the king. If no one knows the move's coming.
You're trying to attack. If you're playing white, you're trying to attack f7 field.
Yeah. If I do that and they don't know what's coming, the game's over. If they do catch that and they make the 1 correct move or 2 correct moves, I have no idea what I'm doing. I lose basically every time. But if you ever want to play chess, I'm so down. I love it. I would love to learn.
So, by the way, that's a great story, Alec. And the funny analogy with investing here would be this: that opening works within new beginners who have no clue what's coming, right?
That's my competition.
The problem is that if they actually know what's coming, it's very easy to protect against it. And by the way, after that, you is in a very bad position to continue the game. You're just like strategically poorly positioned because you took your queen out way too early instead of developing the rest of your position. And your opponent will have assume the equal level of skill between you and the opponent. And your opponent knows about the trick that you're trying to play on them. In that case, given the equal level of skill, you put yourself into a disadvantageous position, and they have a high chance of winning because you try, to trick them. So kind of it goes both ways.
Yeah, coming from a firsthand experience, I can definitely say that is true. It does not usually end well if I don't get the 4 moves.
Yeah, there's a quick point that I'd like to make about that. I think that complex problem solving in situations that can be stressful relates so well to every skill that you really could think of. I mean, for example, I'm very into martial arts. Artem, you're very into chess. There's people that are ultra marathon runners, whatever it may be, that constantly problem solve through their everyday life, but it relates so well to the way that they conduct themselves as a professional and in friendships or relationships or whatever it may be. So I think that it's really cool that we had the conversation too. For the final question, I would like to ask this, and I'm going to ask this to every single person that comes on this podcast, because I think it's really important. So if you're listening and you're coming on in the future, just be ready for this question. Artem, what is one question that you wish we asked you?
Oh boy. We covered a lot of good ground.
It's a tough question. I think it's important too. Somebody asked me this one time and it stuck with me like the same way it's happening right now. And then I finally came up with one.
What did you come up with?
I think I came up with the question of what was my leading motivation in day-to-day life. I think, and then I went with my answer. And my answer being, my family, my girlfriend, the job and the opportunity that I've been given, in the life I've been given is definitely the motivation. Because when you think about it, like it's not really, people take a lot of things for granted. But right now I am a healthy body. I'm able to do so many good things. And I'm also able to make a difference in my professional life. So, treating people with kindness is a great motivation for relationships. Working out constantly is a great way to take advantage of the opportunity I have to be in a healthy body. And coming into work and trying to give my best effort every single day is a great way to take advantage of the opportunity that I've been given.
That's a good one. I like that. Okay, so now I will answer your question.
Your one question that you wished we asked.
Look, so we've covered a lot of areas of investing and a lot of elements of investing that are positive, right? You figuring out an interesting intellectual puzzle, you discovering a hidden gem, you figuring out why the company does some things better than other people, why the product works, why the customers are happy. So this is the journey of intellectual discovery, which is incredibly enjoyable if this is what you like, right? And then at the end of the day, you also receive the financial rewards of you being right. So that's wonderful. Now, I think there's also another side of the journey is periods like March 2020, when it's very gloom and doom. And, many people do not really appreciate that those things will happen. There is no way, or almost no way, that you will avoid them. And that's, that's the inherent element. So I think the good question would have been is, Artem, how are you dealing with those moments? Like, what do you do? How you don't lose your sanity? Like things like that, because those things happen. And to the extent, going back to Alec talking about his approach to his managing his personal portfolio, is those things come up for everybody, whether you're a professional investor, whether you're an individual investor who has a full-time job doing something else productive for the society and invest in their portfolio. So those things come up, it's unavoidable. So, and I think my answer to the question would be this. The way I think about it, it's you're building your mental muscle. So I launched Caracan Capital LLC like 6.5 years ago, and I lived through a few periods when markets were volatile. And I think the first big one that really registered in my head and my psychology and my heart was fourth quarter 2018. And that was a lot more difficult than March 2020. Because I do think you develop this emotional muscle, this mental muscle, that it gets better over time. And it helps you handle that. And putting things in perspective helps you. Those periods normally, based on the history, normally pass. Sometimes they take a few years. Sometimes like early March 2020, it took only a few months, right? Sometimes it takes longer, sometimes they take shorter, but you need to put those things in perspective. And also you need to understand what you actually have in your portfolio. And if you're worried about long term, it means that you probably have wrong things in your portfolio. If you have the right things in your portfolio, you're probably not that worried. You're stressed, but you're not that worried. And also, I've learned this phrase recently from a friend in the professional world. So Jonathan, if you're listening, credit goes to you. And we were chatting with him about tennis because the final of the US Open was coming and Djokovic was playing with Medvedev. And we were chatting about that. And my friend mentioned the Djokovic phrase when someone asked him, how do you deal with pressure? And his answer, pressure is the privilege. So I've never heard that quote from Djokovic. So thank you, Jonathan, for sharing that wonderful quote with me. So I think it's a very powerful reframing. Like if you are dealing with that pressure in the moments of market sell-off or market volatility, that's a privilege. You're privileged that you're running a portfolio, whether it's your own or whether it's a fund portfolio, it doesn't matter. You have that privilege of doing something that you really enjoy with the portfolio, with real life money. And again, if you are good at that, you will be rewarded and you have an opportunity to get feedback from the market that and obviously short-term feedback is probably meaningless, long-term feedback is meaningful, and that you can incorporate and get better and grow as an investor. So I will finish with that. Pressure is the privilege.
Wow. That's a great quote. Now I'm relating it to everything almost mentally, where it's like pressure is the privilege, right? Where like we just talked about with my answer to the question when somebody asked me this was I have this opportunity and I need to fill it. The pressure is what pushes you, right? There's another saying about pressure. It's like pressure either bursts pipes or makes diamonds. So
Yeah, that's a good one.
So
Where you guys get quotes from, man?
Yeah, these
Alec, it's your time. No pressure.
I don't got any, man.
Yeah, Alec, you need one quote about pressure before. No, I'm kidding.
Alec, go to Google right now.
Yeah. Thank everybody for listening today. Artem, it is always a pleasure. You are a super intelligent person. We admire your work and your energy. So thank you so much.
Thank you, Sam. Thank you, Alec. Great talking to you guys.
Thanks for listening to the Conversations podcast. If you have questions or comments, feel free to reach out on Twitter or send me an email at sam@avenelfinancial.com.